And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? Hope you're doing well, taking a little bit of time for yourself, and welcome to today's program. Let me ask you a question. Have you ever tried to find your way to a destination, maybe based upon a friend or family member's verbal description, and maybe it's not even really a map, it's just kind of a sentence of landmarks, and you kind of have a general sense and an idea of where you're going, but you end up getting kind of lost because you really don't have a true sense of direction, you don't have a map, you don't have instructions to get there. Well, I'm just curious how many Americans today are paying a really big tax because they're flying blind. In other words, they're paying the tax of ignorance. They are paying the taxes due as really a dumb tax. And I don't say that to be disrespectful. We've been taught that ignorance is bliss, but we also know that, well, as funny as that may sound, as comical as that may be, the reality is that being ignorant generally costs us something. It might cost us time. It might cost us money. It might cost even a retirement. And this is the serious part of planning for retirement. You know, how many things in life can just kind of creep out of nowhere and take us by surprise? And the only thing that we can really say is, well, I didn't know that. Well, today we're going to be discussing maybe some of those hidden areas that you didn't know. Things that maybe you might be doing here right now today without any knowledge of what it's actually costing you. So we're going to run through a whole gamut of different things for you to be watchful for, things that could be that potential speed trap that you didn't know was there. Now, if you're brand new to the radio show, to the podcast, not only do we want to say welcome, we want to say thank you so much for coming. And we would invite you to come to our website, johnsonwim.com. There is a wealth of information on the website. There's white papers, there's old radio shows that you can listen to, there's podcasts that you can watch, things even on YouTube. If you go to our channel, Capitalized Life. And here's the thing. There is no such thing as being too well educated for retirement. We want to be able to know what it takes to retire. And although you've been told that it's just about the points on the board, well, what good are the points on the board if you can't win the game, if you can't enjoy what you worked hard to save? We want to be able to turn that bucket of money that you worked so hard to save into income that you can enjoy, income that's real, income that's tangible, income that allows you to take the trips and buy the things that you want to buy to maintain your standard of living. And most importantly, to do it without the stress, to do it without having to sell anything, even if it's during volatile times, even if it's during scary times, times like we've had in the past in the market, and times like we're certainly going to experience in the future. So let's get down to business. So in no particular order, let's start with something very, very simple. Now, as much as I would like to think that just literally every single person in this country knows that if you take distributions from a 401k or from a 403b, you're going to pay an extraordinarily high mandatory taxation. Well, most people still don't seem to realize it. All too often, we think that the same tool that got us to retirement is going to actually get us through retirement. And the reality is that that's not always true. We want to realize that there's two different stages of life. There's the accumulation stage. And this is where we're not really paying attention to a lot of risk. We're just focusing on growing and compounding our money. We want to take risks. We want volatility because it helps us with dollar cost averaging. And we want to grow that bucket of money and really not worry about it because we know we can't really touch it until we're 60 anyway. But once we get to that time frame, now we're 60, we're getting closer to retirement. Now, all of a sudden, we have to start thinking about, okay, well, how do I convert all of this money into income? Well, for most people, they just do the opposite of what they've done for 20, 25, 30, 35, 40 years. They pick up the phone, they call the institution or the custodian that has the 401k or the 403b and say, send me $1,000 every single month. Not realizing that not only are they selling shares in order to get you that income, so you're essentially exchanging one asset for that of another, and you're cannibalizing your principal. But not only that, because the 401k, the 403b wasn't designed for distribution, it was designed for accumulation. Now, even if you've retired, your income has definitely dropped. Now you're on Social Security, maybe you got Social Security and a pension. Well, guess what? You're in the 12% tax bracket, but those employer plans are forcing you to pay a mandatory 20% withholding. Now, you can tell me, hey, but it's not a big deal, Matthew, because I'm going to get the money back the next year. Well, that's true, but let me ask you the question. Do you really think that it's worth you taking more money out of your pocket and giving it to the government, the IRS, in the form of a tax-free loan? Do you think it's worth giving them an interest-free loan? Because guess what? The government does not pay you interest on the excess withholding that you did. And number two, they're not going to pay any tax on that money. Not like you. So do we really want to give it to them to begin with? And you see, this is one of the key areas. If you're close to retirement, you've got that 403b, you've got that 401k, you may be very well entitled to do what's called an in-service rollover. Even if you're still working for the company, you're still employed by them. If you have a 401k or 403b, you have the opportunity of being able to take those winnings off the table and roll that into a personal, traditional retirement account. And guess what? When you pull from that account, when you take a withdrawal, whether it's income or principal, it doesn't really matter. You're not going to have a mandatory withholding. How cool is that? So ignorance is not bliss. If we understand that we're overpaying, we're giving the government a interest-free loan, well, that's a real ripoff in my opinion. And yet so many Americans do it just simply because they're flying blind. No one's ever told them otherwise. What's another one? Well, another one is going to be an actual tax. Now, this is something that not every person contends with, but I've seen so many over the course of the last 25 plus years that I've been an advisor that I think it's worth mentioning. And that is this, the surprise capital gains tax. You see, if you're investing in mutual funds, you're investing specifically with an institution where their business model is going to be generally mutual funds instead of individual holdings. This is one of those key areas where during bad times, it's especially painful because you see, when you invest in mutual funds, you are paying one, if not two different institutions for the management of your money. You're obviously paying your broker who sold the mutual fund to you, and maybe that broker is getting paid, we'll say, a commission of some design when he sold that mutual fund to you or she. And then once you've put your money into the mutual fund, realize that the fees generally don't stop. The fees are going to be continual. You're going to pay things like 12B1 fees. You're going to pay expense ratios. And realize that your advisor, your broker, is not the one that's managing that fund. That broker is the one that simply suggested that you invest in that fund. That fund has its own fund manager, and it could have more than one. Now, here's the thing. That fund manager is going to do what he gets paid to do, and that's manage. And so in specific circumstances, when we have post-tax money, this is money we've earned, we've paid the income tax on, and now it's just pure principal. When we invest that after-tax money into things like mutual funds, we could have a year, we could have several years in which the mutual fund is down. We have lost value in the fund. And yet at the end of the year, or rather the beginning of the next year, we get a 1099 in the mail that says, oh, congratulations, you owe taxes for capital gains tax. And you throw your hands in the air and you're like, what in the world? I have no idea. How is that possible that I owe taxes for capital gain when I'm looking at my balances right here, Matthew, and it shows that it's down? Well, folks, that's what happens with mutual funds, where you may end up having the fund manager sell a position or maybe a number of positions within the fund that have a relatively low cost basis, and they're worth more. They're being sold for more than what they were bought for within that bucket of holdings. And so this can be like a poke in the eye with a sharp stick, where you're getting put on the hook for taxes, even though you didn't ask for anything to be sold. And you see, you relinquish the control when you have a mutual fund. You are not responsible, nor do you get to call the shots when it comes to the handling of the various different assets that are within that mutual fund. And so one of the ways that we want to remember, just like rolling our 401k or 403b to an IRA, will allow us to not only garner access to our money, we can invest it the way we want, we can potentially reduce expenses, and we are getting rid of that mandatory withholding. Well, when it comes to post-tax money, I've always been an advocate of investing in individual holdings. And the reason being is because when you invest in individual holdings, you're in a position where you bought that stock or you bought that position at a particular price. Well, you're going to be in a very different situation. You could essentially hold that stock, and even though it is appreciated to the moon, well, you're not going to be put on the hook for capital gains tax, and you'll be able to pass that on to a spouse. You'll be able to pass it on to a child. And here's something kind of cool that we don't always talk about. When you die, there is a stepped up basis on that asset. It's very much like real estate. So if you bought a stock at $10 and now that stock is worth $110, well, you know that there's $100 worth of appreciation, there's $100 worth of gain. But if it's in a post-tax account, you've got beneficiaries such as your children, and you pass away, well, it's going to have a stepped up basis. And that's pretty darn cool, because now what happens is it basically affords you the opportunity of giving away a tax-free instrument, a tax-free legacy to your children. Let me ask you, is there really anything better to give to your kids and to your grandkids than money that's totally tax-free? I think it's pretty cool. Now we're coming up on our first break. Sit tight. We're going to come right back with more gotchas, the taxes that we all pay for flying blind, meaning we just don't have a true set of directions. We don't have an advocate that's helping us with turn-by-turn instructions to get where we want to go. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, if you're just joining us, welcome to today's program. Today we're discussing kind of a play on words, the tax that we pay for flying blind. You know, not too many of us as human beings would just get in our car and just start to drive. No destination in mind. Or if we have a destination in mind, we wouldn't have a way of conveyance with directions on how to get to where we're going. Not many people hit the trailhead without having a map and knowing where the trail is going to split and how to safely navigate the trail to be able to get back to the car in the parking lot. There's not too many of us that kind of raise our children in such a way where we set them out and say, well, you just have to do and find out. And we keep it as a giant surprise. For the human being, we like to know where we're going. We need direction. And you know what? All too often in society, we seem deterred from reaching out for help, as though help is somehow creating this notion that you're helpless and that you can't do it yourself. Well, the reality is that that's not true. We all need help. If we have medical needs, we go to a doctor. If we have legal needs, we go to an attorney. If we have tax issues, we go to a tax preparer, a CPA, an accountant. If we have financial concerns, We work with a financial advisor, a wealth manager, someone who is a retirement specialist to help us retire comfortably. And so maybe you've been flying it blind. Maybe you've been going it alone. I'm going to be the first to tell you that even though I hope the best for you, and I really do respect those that try to do things on their own, the reality is that oftentimes there is such a value added to a person's life, to an investor's life, when they involve another financial professional. If nothing else, to help educate them in further ways, to help to maybe give a different perspective, a different point of view, maybe to help them when they're going through an emotional time to make good, sound financial decisions, even though they may be feeling fear or they may be feeling, the dread of what's going on in their life. It could be the loss of a loved one. It could be the stock market tanking. It could be any number of different things. But mark my words, when you fly blind, there's always mistakes to make. We've all done it. We've all made them, even myself. When you don't have the proper leadership, when you don't have all of the data, all of the context, it's easy to make mistakes. The point is that, as I've said many, many times, the accumulation stage of your life, you can afford to make those mistakes. However, the distribution stage of your life, well, that's a totally different story. And the injustice here is that we spend, generally speaking, 40 years of our life to accumulate, simply to have to make that money last for the next 20. And that can be scary for a lot of folks. So whether it's this radio show, whether it's my book, The Capitalized Retirement, whether it's past podcasts that you watch on our YouTube channel, or white papers that you get from our website, johnsonwim.com, I encourage you to continue to educate yourself. Come to workshops, watch webinars, come in and have a consultation. These are things that can help you avoid making those costly mistakes. So let's go back to what is the tax for being ignorant? What is the dumb tax, as I like to tell my children? We've all paid the dumb tax, right? Even as parents, we've paid the dumb tax. Well, what is another dumb tax that we pay? Well, here's a new one for you. How many of you currently have annuities? And how many of you have post-tax money in those annuities? So we're not talking Roth money. We're not talking IRA money. We're talking post-tax money, after-tax money, money that you've already earned, you've already paid the income tax on, and you made that deposit into that annuity, okay? Now, there's our two criteria. We've got an annuity that has been funded with post-tax money, and we are taking payments. We are taking income. Well, one of the areas that I see so often, and it so aggravates me, I understand that there's going to be turnover in the financial services world. I get it. When you get a representative, then all of a sudden, it seems like after a few years, that guy, that gal, they either retire, they move on, they change positions, maybe they get promoted, maybe they get kicked out, maybe they just quit. I know it can be super frustrating, and it's even harder when you're working with, say, an institution. Maybe you've got Charles Schwab, maybe you got Vanguard, and the only thing you have really access to is just, some person in a call center who's answering your phone call. So you really don't get that personal representative and financial advisor that's duly licensed and really knows you and knows your situation. But here's my point. It's like the drive-by annuity sales, where a person gets an annuity, maybe somebody dropped by your house, knocked on your door, sold you an annuity, sounded like a good deal, and then before you know it, they're gone, and you don't ever hear from them again. Well, oftentimes I'll find that eventually these people that own these annuities will come to a point where, out of desperation or whatever, they will turn on the income and they'll start taking the income. Well, let me just enlighten you for just a moment and explain to you how the taxation of annuities function. I want you to imagine a big 5-gallon bucket, and I want you to imagine you've got $100,000. This is post-tax money. You've already paid the income tax on it, and you take that and you put it into this annuity bucket. what's going to happen is that principal is going to sink right to the bottom. Now, I want you to imagine, just play along with me. Let's say that 100,000 in that annuity is producing 5%. Okay? And so every year you're making $5,000, and then it turns into $5,100, and then it turns into $5,300, and it's compounding on itself, right? 5% per year, compounded interest. What is that? The seventh wonder of the world, according to Albert Einstein, something like that, compounded interest. But I digress. So what's happening with this interest that is being deposited, that your 100,000 is earning, is that it is sitting on top of your principal. Now, my friends, that is designed by the IRS. That is designed for their benefit, not yours. We would prefer, you and I would prefer, that interest would float to the bottom or sink to the bottom, right? Well, the reason that it floats to the top and it stays at the top is because the government wants to assure themselves that when you go to take a withdrawal, the interest is what distributes first, okay? It's the first thing that gets distributed. Therefore, they get their taxes sooner. They would prefer for you to pay tax now than to pay tax when you're 80, okay? So as a result, here's the quandary that I find the mistake that people are paying, the tax that people are paying. So when you start a distribution and you know that it's all taxable interest coming out, you're probably going to do something called withholding, right? And you're going to say, well, I want 12% withholding. I want 22% withholding, whatever it is. And so you're not getting the full check every single month. You're getting the net check because you're sending some of it to the federal government. You're sending maybe some to the state, depending upon the state that you live in. But I want to ask you a question. What happens if you've been receiving income long enough that you have completely used up all of the interest? Do you think that the insurance company that you're receiving the payments from is going to notice that, and they're going to reach out to you and they're going to say, hey, by the way, you are now receiving tax-free principal from your annuity contract? Do you think that they're going to do that? Well, you can probably already tell by the tone in my voice that the answer is no. It has probably never happened, and it probably never will happen. And so you see, one of the taxes that people pay for flying blind, not having advice, not having an advisor, is the fact that you could be living on less income, not because you have to, but simply because you've always done it this way. You've always allowed them to take and do withholding, when I'm here to tell you, my friend, that if you've got an annuity, you've got money in post-tax, or you've got post-tax money in that annuity, and you're receiving payments, you may very well be to the point where you no longer have to be doing any withholding. You see, how would you like an extra $100 or $200 or $300 in your pocket? This could amount to thousands of dollars per year. And yeah, you get it back, but we've already kind of addressed this, right? Why would you want to give an interest-free loan, a tax-free loan to the government? The government doesn't pay taxes, and they certainly don't pay you any interest on that money. So why would you do that? Why not keep the money in your pocket? So if you have annuities, if you have old annuities, these are annuities that maybe you've had around, but you don't even know if you have a representative anymore. You don't know if they're competitive. You don't know if they're really doing anything good for you. This is something where I encourage you to get with an advisor, get with a fiduciary, and get a second opinion. You very well may be able to find yourself in an opportunity to make a massive upgrade, something that could significantly help you in retirement, just simply because of the interest rate environment that we're in today. Remember, the last time that we were in a really high interest rate environment was back in the 80s and 90s. Folks, it's been a while since we have been here. So I think you're starting to see my point. The financial advisor is an absolute intricate part of being successful in retirement. It's not that every single person needs a financial advisor. But you know what they say? A second set of eyes never hurt anyone. The opportunity of being able to have a financial sounding board, be able to talk to someone who doesn't have an agenda to sell you something, a true fiduciary, someone who's already successful. They don't need to, make their living off from the next person walking through their door. Someone who already has an established business and already has a skill set and an area of expertise that is exactly what you need for this stage of your life. I'm going to encourage you, design and involve yourself and get a relationship with that person. Have an advocate to take care of you. One of the worst things that we can do is we get older, things begin to slip, and we have no one to count on, no one to keep us flying right, no one to take good care of us and to make certain we're not making mistakes. And as much as I want to say to the do-it-yourselfer, attaboy or attagirl, the reality is that only works for so long, and then it starts to get scary. So I encourage you, my friend, think about the tax that you may be paying because you are flying blind. Fix that issue. Get with an advisor. Get yourself a fiduciary. I'm Matthew Johnson. Thank you so much for watching and listening. And remember, it's up to you to make today a great day.